Excellent. All right, so everything we're talking about today, and I just shot this email out. I'm sorry, I apologize. I had a little hang up with the scanner this morning, and going through so much information, I didn't want to be at a point where I'm not getting you what it is that I'm talking about, because it seems like it might be a little difficult to follow along. But the first of the month, 2 days ago, if you watching the local news, there were announcements that there were all kinds of changes in pricing for conventional loans, and basically it comes down to the way that loans are priced out. And it wasn't the government loans through FHA and VA. There was some concern that they're punishing the people that are well qualified and higher credit scores, and the people with lower credit scores are benefiting. I had some people that thought that maybe everybody gets the exact same interest rate and there's no more adjustments or anything at all. So we're ahead of the curve and we're understanding what's happening in the marketplace. I wanted to address it in the first training we had for the month. The second page in the sheet that I sent out, if I just kind of thumb to it, this is a graph that talks about, and these are the way that loans are priced out. So we have a base rate, and then there are adjustments to the base rate based on loan to values and based on credit scores. And this is with conventional loans. So the top heading up here are all loan to values, and the left column down here are all credit scores. Everything that's in red is the pricing that got worse. And everything that's in green is the pricing that got better. So the higher loan to values way over here, 90 greater than 95 loan to value, they got better. The lower credit scores all the way down here in the bottom bucket at 660 and down, or 679 and down, they all got better. The ones that got worse, and really the ultimate worse right in here, 0.75, that's 0.75%. And this is all based on the loan amount. This is a cost for the same rate based on the loan amount. So for every 100,000 in loan amount, that's an adjustment for an extra $750 cost. That's what that means. This 0.5% over here would be on a $100,000 loan amount, $500 adjustment in cost for the same rate. But this 740 to 759, so let's call it 720 to 759, these two buckets over here to the left, for an 80%, 80.01 to 85 loan to value was the worst. And this is not arbitrary. So the agencies, in looking at this, it used to be skewed to the extent where the high loan to values way over here, they really paid dearly. No doubt about it. The lower credit scores really, really paid dearly in comparison to higher credit qualifying. Read a clip in the agencies are basically looking at the default ratio for loans that are being made, and which loans pay out well and which ones have a higher default ratio. And quite frankly, loans are very well qualified after the downturn in the economy in 07, 08. There were a lot of adjustments, more federal regulations in our industry in that maybe 2-3 year time period than there had been for the 80 plus years combined prior to. So the government felt that they let down the American public by not regulating the industry more so in the mortgage side. They thought things were too loose. They put back all the regulations to the states and nothing was done on a federal level. So the government came back and they instituted a lot of different federal regulations. And one of them is called a qualified mortgage, which means you're qualifying based on your IRS tax returns. And there's a lot more, how shall I say, background checks and double check, triple check. The age of technology is more prevalent now than it ever has been with regards to identifying if the applicant truly is unmarried or married, and maybe they're sandbagging us and not being truthful, or if they have any additional properties that they own, if there's any IRS issues hanging over their head, if the income is even legitimate and correct. Everything is verified these days. So this entire adjustment here was largely based and created on the fact that, why are we punishing people with a little lesser credit score? They pay their bill. At the higher loan to value, quite frankly, they're not defaulting at any greater clip than ones at a lower loan to value. So what happened was things got a lot closer, a lot tighter the way that they're priced out. Okay. And I went through some examples, and I included some rate sheets in here. So this is basically just an illustration. I'm not saying it's super easy to people that are not in industry real estate professional to understand. It's like, God, huh? All the zeros over here, they're no adjustment. So these are low loan to values, 60% or less loan to value, all the way down to 660 credit score, no adjustment at all. And then the people with less than that actually got more favorable pricing. So for the lesser than 659 or 659 and down, I got a little enhancement. I included rate sheets in here just to kind of put everything, and I'm sorry that this is really small. If you could increase on the email that you got, if you're following along the email, you could maybe expand the screen, but it's really tight. And I kind of color coded this stuff. And I included a sheet at the top, so I'm going to kind of scroll back and forth on this if I could. But this is a conventional loan program. So it fits into the exact bucket that color-coded illustration that we just looked at. So this is what we're talking about. These are conventional 30-year, 21 to 30-year fixed rate is what it says up in here in the top left corner. UWM is the largest wholesale lender in the nation. I just picked their pricing, very aggressive pricing. So I mean, their pricing is good. For a conventional loan right now, and these are number of days rate lock. It's tough to read here. This is 15-day column here, a 30-day rate lock column here, and a 45-day rate lock column here. Okay. As far as the interest rate on this far left column at 5.5 is highlighted in yellow. The 5.5% interest rate all the way in the 45-day rate lock is 0.006. The heck does that mean? It is a percentage of the loan amount. And if it was shown as 0.000, it would be a base rate with no rebate or lender credit, mean the same thing. The lender's not crediting you any money, and there's no cost to buy the rate down. So 0.000 in our industry is called par. No cost and no rebate associated with that rate. 0.006% is actually $6 cost for $100,000 loan amount is what it equates to. So it's closest to par, which is why I highlighted the 5.5% conventional program, 45-day rate lock. Who the heck gets that? That's the other side of that the coin is, okay, that's great at 5.5%. That's the base rate. Who's entitled to that? Who gets that rate? Here's the real deal on the pricing adjustments. And this is after the adjustments have been put into place. So this is not the color-coded illustration. This is already everything in place as is right now, rate sheet today. And this top section up here at 780 credit score, all the way up here at the top for a 75% loan to value, gets the 5.5% interest rate here at the 0.006 cost. Okay. And it would be anybody that fits into all the zeros over here. So just like the 780 score, do you have to have a 780 score to get that rate? No. If you had a 70% loan to value and a 760 credit score, you get the exact same pricing here, 000, no adjustments. If you had a 60% loan to value, all the way down to a 640 credit score way down here, you're getting the exact same interest rate. So 60% loan to value is very low. That's a lot of equity. Who's kidding who? So anything that prices over here in the zeros, there's no adjustment to the pricing. Okay. If you go to the extent, and I put on the top sheet, don't mean to get you dizzy here spinning around. 5.5. I apologize. That was a mistype. 5.5. I'll correct that and resend it out. 5.5 is a 780 plus score at 75 loan to value was the base rate. I put other examples in here at an 80% loan to value with the 700 to 719 score. If I go back to the rate sheet just very quickly, that other example in here, if you do these adjustments in green, I flag this as an 80% loan to value here at 1.375, at a 700 to 719, the exact same 1.375 way over here to the right at a 95% loan to value is a 680 to 699. Big spread. You'd say like at the 80% loan to value, there's the exact same adjustment as a 95 loan to value. At the 80% loan to value, they have a higher credit score. So you would think that the 700 to 719 is a better score. The 80 loan to value is more equity. Why would they get the same pricing adjustment? Why is that the 680 to 699 at 95 get the same? You know, the truth of the matter on anything over 80% loan to value is there's mortgage insurance over here. So all this pricing over here, the lender has the benefit and the safety net of having mortgage insurance such that if the borrower defaults, they are going to be covered all the way down to 78 cents on the dollar. So if they had a $100,000 loan amount and they had to take a loss through the foreclosure proceedings and eventual sale, they'd be covered all the way down to 78. Like that high end loss in that example for 100,000 to be covered on that top 22% of their loss potential. So they'd be reimbursed. They'd be made whole. So weird to think that this is the exact same, but what does the 1.375 equate to? That was the green adjustment. This, and I know it's tough to read, this is minus 1.506 right here. And it's at 5.999%. So once again, if the premium adjustment was 1.375, that means it comes away from that rate and you're getting maybe about 1/8 of 1% is what the net remainder would be a lender credit at 5.999. So the 5.999 all the way to the top sheet up here is the one that gets the 700 to 719 at 80 or the 680 to 699 at 95. Same base rate, 5.999. Once again, the person that's in this 680 to 699.95 LTV is going to be paying monthly mortgage insurance as well. But it prices out the exact same based on the new loan level pricing adjustments. This was not the case prior to. The person that was at the 95% loan to value was paying a lot more than the person at the 80 LTV. So the fact that it swung in, but I think that there was not as much consideration over the fact that mortgage insurance is in place and the lender's protected. So really, in essence, as much as you'd say, well, the lender's lending 95% loan to value, isn't that risky? They're covered all the way down to the exact same spot that this one is. I mean, it's not any, from their standpoint, they're incurring the exact, similar level of risk. And they're priced the exact same. Things jump on this next example here. I did the 640 score to 90 loan to value as well. Kind of rolling all the way down to these loan level pricing adjustments. Down in here, 640 to 659, that's the pink highlighter. At the 2% pricing adjustment. This is the 90 loan to value, 640 to 659 credit score. And on that one, the rate jumps. You're up at 6.375%. We were getting a little over 2% in lender credit. And it goes bye-bye with the pricing adjustment. So that 2-point pricing adjustment as a result of being a 90 loan to value coupled with the 640 to 659 credit score means 6.375% is the base rate for that person. We have instances with people that we get referrals from. This happens quite often. God bless our industry, but referrals are the immaculate conception. But we could have referrals from family members, brother and sister. We could have referrals from identical twins that have the exact same job, that bought the exact same model and the exact same housing tract, on and on and on. And one identical twin could be the person that falls into this bucket here at the 75 loan to value with the 780 plus credit score, or with no pricing adjustments that we looked at. And they'd be looking at base pricing at 5.5. The other identical twin could be, you know what, I only have 10% down, Greg. I don't know what to tell you. My credit score is 645. You drop into this bucket. So even though, you know, they're you know, very similar in nature as a result of them being referred one to the other. And it's something, quite frankly, I don't get into particulars, but from a training standpoint, what I suggest to our loan officers, if you're getting referrals from individuals and they're not getting the same pricing, it'd be good to at least let them know that you got the best financing terms that were available for you and your qualifications, and the other individual that was referred got the best financing options for their situation based on their credit score, equity, and everything that they have going into it. But on each of these two here, that's almost a full point spread in rate, 5.5 up to 6.375, you know, for nothing other than equity and credit score. But the way that it prices out, it's our entire industry is based on risk. And the more the risk, the higher the rate. The less the risk, the lower the rate. And it's pretty well on every program that's out there. Okay. One's in blue up in here. And just to give, you know, some examples, I put up in the top sheet, conventional loans. Once again, I'm going to correct this. That should be 5.5. We looked at the conventional loans here. These are all owner occupied, primary residence. Okay. Right below here, I put in non-owner occupied, rental. Okay. So for the rental properties, if I flip back to the loan level pricing adjustments, once again, these were in blue. Bam, bam. I put together a couple options here, but in blue, conventional loans have this pricing adjustment for investment properties. It's 75, 70.01 to 75. Loses 2.125%. There's a pricing adjustment, a cost based on the cost of the rate. And if you go less than 25% down to 20% down, it's 3.375 cost for the rate. Fannie Mae and Freddie Mac have all the way up to an 85% non-owner occupied. 4 1/8, it gets really expensive. I'm not going to discount that. Oh gosh, that's a ton. But even on this investment property here for an 80 loan to value at 3.375, this applies also because I have an 80% loan to value. And I took the example here, 740 to 759 in blue. So if my credit score here is 740 to 759 to 80% loan to value, there's an 0.875 pricing adjustment plus 3.375 pricing adjustment. So when you add those two together, it's 4.25%, not cheap. So the 80 loan to value with the 740 to 759 credit score, all the way up here at 7.625%, was getting 4.102 lender creditor rebate. That goes bye-bye. And it's actually at a it'd be like a 0.15% cost for an 80% loan to value, non-owner occupied, 740 credit score. And a 740 credit score is good. 20% down payment's good. I'm not discounting any of that. So you'd say, man, these people are solid. I agree. Super solid. But the difference of and this once again was an 80 LTV. This one down here at 5.5, if you had a 780 plus credit score, they're getting 5.5 at the 75 loan to value with the 780 score. They're 2 percentage points higher in rate for non-owner occupied at 80% loan to value. So it gets back to the $10 million question that everybody asks right out of the gate is, what's the rate? So what are the rates? How are rates? It all is relative to what are we looking to accomplish, because there is such a large scope of what anyone would qualify based on their score, their loan to value, the occupancy, even property type. This other blue one, I'm going to look at this here really quickly because I went through another investment property here just so you can kind of see the difference in pricing. And I put this one at 75 loan to value, Same 740 to 759 to keep it simple. The investment property for 75 loan to value came down 1.25 in cost here. So that's 2.125% cost. Plus 3/8 is 2.5 cost. We got to find in the rate sheet where we were getting 2.5 in lender credit to offset the 2.5 cost. And that magical rate here is at 6.625. So the person that had the extra 5% down payment got a full point better in rate, the exact same credit score. If you have the money, these are things that we discuss with people. So, you know, as we take a full application, I verify all the money that anybody's got to their name. I'd also ask, you know, what do you want to keep the maximum payment to? It helps us drive to the loan amount you're seeking. And then the other flip side is, how much money do you want total cash for closing? If I knew that you had, you know, a couple $100,000 and it turned out the pricing was so materially different by just putting a little extra down payment for the 5% extra down, you get down here at a full point lower in rate, I'd at least offer it. You may come back and say, I told you I only wanted 20% down. I get that. But I just wanted you to see that you know, how noticeably different the financing would look if you put an extra 5% down payment. Rate is lower, certainly the lower loan amount, the payment's going to be lower. And then the other twist there is the extra 5% down payment is all your money. You're not paying any additional fee. You're just basically creating more equity for yourself. And in simple analogies I have with people, just to kind of, you know, make it easy to understand, when I talk about people and money that they have in net worth, you know, that they have, is just wearing a standard pair of blue jeans. And I've used this example hundreds, maybe thousands of times. Standard pair of blue jeans in the right front pocket is money like that's in your checking account, savings account, money you can liquidate immediately. Liquid assets, right front pocket. Left front pocket would be things like the equity in real estate. You can't necessarily liquidate it immediately, but it still represents money in your net worth. So the example in the extra 5% down payment to get the point lower in rate here to here would basically just be taking a little extra money from the right front pocket and putting it in the left front pocket. But it's still your money. So nobody's taking anything from you. Nobody's stealing from you. You're just getting into more favorable financing. And the fact of the matter is, the interest is all profit to the lender. Okay, you're borrowing the whatever the principal balance in the loan is that you repay. There's no profit to the lender on that. All their profit is coming from the interest that is accrued and paid. That's where they're making their money, most certainly. So that difference in the investment property with the extra 5% down payment is very material. You know, I'm not gonna, and I could go through hundreds of examples in here with all these other pricing adjustments. But what if it's this and what if it's that? Cash out refinances have their own pricing adjustments with Fannie Mae, Freddie Mac. Manufactured homes are in here. You see a 0.5 point manufactured homes across the board. We'll do them up to 95% financing, but this whole line right here, all manufactured homes. So the pricing I gave is just a standard single family residence. If it was multi-unit, 2 to 4 unit properties, they have pricing adjustments. So at points in time, as from a lending standpoint, we need to know everything we're dealing with and not just, oh yeah, the rate's 5.5. Oh yeah, I looked at today's rate sheet, it's 5.5. I would not be doing anybody any service if I looked at the rate sheet this morning and every single person I talked to, I gave them this rate at 5.5 for a 45-day lock. Oh, all day long, no problem. Because the fact of the matter is, not everybody fits into that bucket. In fact, a lot of people don't. The 780 plus credit score is pretty spectacular. So you're definitely on the higher end, 75% loan to value with that 780 credit score, you know, or having just a ton of equity. I'm not saying nobody fits into that, but not everybody does. So rather than be at a point where, and I used this maybe a couple of weeks ago and talking about, you know, every single deal is unique to itself. We don't treat people like sheep. We're not just hurting them. And everybody's, you know, just everybody's the exact same. Bam, bam, bam. Everybody's a unicorn. Every deal is unique to itself. and every person is going to get the most favorable financing for their situation. So on any of these examples in here, when you flip through on any of the loan level pricing adjustments that are down in here, the fact of the matter is I didn't create the client's credit score. I didn't tell them to save more money or save less money or have more down or have less down or have a family that can afford to give you gift money to get, better loan to value or more down payment. I only work with whatever people are bringing to the table. If it turns out we cannot call it an investment property and I could get by with doing it as a new primary residence, then these pricing adjustments go away. But that would not be the case. I live in Covina. I have 3 rentals in Covina and I'm buying another one and they're all condos and I'm buying another condo. I'm going to be hard pressed to say, why on earth would the lender ever think that that's going to be your primary residence? Because you live in a beautiful single family residence now and every other property on your IRS tax returns that's a rental are all condos and you're buying another condo. The underwriter's not an idiot. They're going to underwrite it and price it as an investment property and you're going to be paying the pricing adjustments accordingly. Even when some people are out initially start looking for single family residences and then find, the manufactured homes, boy, I like those. Those are really nice. It's important that we know that because once again, there's a pricing adjustment. So I'm not saying, oh my gosh, the sky is falling, but we just need to make sure that whatever it is that we're discussing is going into the total equation. I didn't price these high balance, but once again, the conforming loan limit's $726,200. The high balance in LA and Orange County for conventional loans is $1,089,300. So you can get over $726,200. You could do it over $726,200 all the way up to, let's say an 80%, 85, whatever, all these loan to values up in here. But this high balance fixed purchase and rate and term refi, if you're at over 75, there's a 1-point pricing adjustment for the high balance loan limit. If you're at 726,200 or lower, then that does not apply. So even with some folks, it could be, for us as lenders, we're pricing a transaction that 10% down pencils in at a 730 loan amount. I would be an idiot if I didn't suggest, hey, do you have an extra $3,800 we can bring in to drive the loan amount down to 726,200 and get better pricing? If they don't have the money, then they don't have the money. But I should have a very good, complete, thorough application. And without even asking or posing that question, I should already know the answer, whether they have the money or not. And then it's just a matter if they want to do it. If they don't want to do it, no big deal to me. But if your loan amount was 730, what is this 1% pricing adjustment here for the same rate? 1% on 730,000, $7,300. It's a lot of money. And that money goes to the lender for the cost of the rate. So in that stupid example, 730 to 726,200, you could bring in an extra 3,800, drive down the balance, keep the money from the right front pocket to the left front pocket, all your money, nothing cost to the lender, spend an extra 3,800 to create more equity for yourself and your family, and not spend the 1 point on 730, which is 7,300, and throw it in the wind. So in that stupid example, quite frankly, they would be foolish not to say 726,200 loan amount all day long. Where do we sign? Okay. So on any of this stuff, in at points in time, does it get a little confusing? It's just a matter of just knowing what it is that we're dealing with and just being aware and being knowledgeable, not at a point where you just got your head in the sand. Like, oh, who cares? Whatever, I'm not making the payment. What do I care? If you have a little bit more, sense of care, concern, awareness as to what people are going into and where the pricing breaks are and where differences might arise, you get a lot better financing terms, hands down. It used to be the pricing difference from investment property to second home in here. These are all the exact same now. As you look across the board, the second home will go to 90% financing now, but it's a whopping 4.125 down here. So big pricing hit. Non-owner occupied only goes to 485 loan to value. But they're exact same pricing adjustments for second homes or for rentals. And that also did not used to be the case. It used to be that investment properties paid much more than a second home. Now they're all in the same bucket. So on the top sheet, all the way back here, feel like we're on a roller coaster. Owner occupied, we talked about. Non-owner occupied, these couple of buckets. This should be 5.5 once again at the base pricing. So we went all the way from 5.5 for owner occupied with the good score, low loan to value, all the way up to 7.625, also with the good score. I'm not discounting the 740, 759 versus 780, not a big spread. 80 loan to value to 75 loan to value, not a big spread. Non-owner occupied to owner occupied, big spread. So the difference here of 2 points in rate from owner occ to non-owner occ is definitely material. I'm not going to discount that. We're going to look at FHA loans and just look at how much better pricing is on FHA. So FHA and VA are going to get you in the low 5s. And FHA just came down with their monthly mortgage insurance, was just reduced. So it's very favorable. FHA is owner occupied only. So this pricing here, government product pricing, this is FHA right here. FHA 30-year fix is what we're talking about. And color coded these. Base rate also here, 5%. 30-day rate lock is a 0.013% rebate. $13 is a lender credit for 100,000 loan amount. Okay, so base pricing is 5. Base pricing for conventional is 5.5. FHA, right, wrong, or indifferent, you know, it's got to be owner occupied for a purchase. The only non-owner occupied for either FHA or VA would be a refinance from an FHA loan to an FHA loan. They call it a streamline. And the only rental or investment property for VA that's allowed is VA to VA. They call it an interest rate reduction loan. IRRL is EARL, VA EARL is the acronym. So you had to have purchased the property as your primary residence for FHA to do a streamline, and then you turned it into a rental. You can do that. You had to have purchased the property as your primary residence with VA, and then you turn it into a rental to do the VA EARL. But these are all primary residents. Okay, if they can fit into the FHA loan, I mean, we're pricing, you know, options here, and FHA pricing is very, very lucrative. So base pricing here, 0.5 point less in rate. But if a client has a certain cap on what they want to keep their payment to, it could very well be you're getting more home with the FHA loan because you have a lower rate to stay within the same payment. Okay. I did some other examples down here in the green and the pink with the pricing adjustments. This green in here is a 640 to 659. Look at how little the pricing adjustments are for government loans. There's nothing, so little. They don't punish you for loan to values like they do with conventional loans. And a 660 and higher credit score all drops into the exact same bucket. This adjustment here, 640 to 659, is an adjustment of 0.5%. So 640 to 659 goes up 1/8 of 1% rate, 5 1/8. You were getting on a 45-day lock, 5.85% lender creditor rebate. That would go away at 640 to 659, and 5 1/8 would be the base rate for an FHA buyer or borrower with the 640 to 659 score. And the rate jumped up here if they were in the 620 to 639 bucket. So if this credit score is 620, UWM won't do an FHA lower than 620. We have lenders that'll do much 580 all day long, no problem. And we have lenders that'll do FHA all the way down to 500, but you need 90% loan to value. They won't do it with just 3.5% down. So UWM, you know, in some respects kind of cherry picks with higher credit scores, but their pricing is really good. So if I had a 620 to 639 FHA, that drops into that 1.25 is here. So 5.5 would be the rate. But if I go all the way back up to the top sheet and just compare FHA to a conventional program, providing you fit into the county loan limits and everything prices out, look at the difference here. Once again, FHA is owner occupied. This top bucket up here was conventional, owner occupied. If I pick this 95% loan to value, 5% down to 680 to 699 score at 5.999, 95 loan to value. FHA with 3.5% down at only a 660 and up score is at 5. Conventional is at 5.999. A full point higher in rate on conventional than with FHA based on the current loan level pricing adjustments. It really is shocking. It's a lot in simple math. If you had a $600,000 loan amount, as an example, 1% in rate, simple interest is 1% in rate. 1% times the loan amount of $6,000 on 600 grand loan amount. So you pay an extra $6,000 in interest per year, divided by 12 months in payments, means your payment's $500 higher for a conventional loan than for an FHA loan at a $600,000 loan amount. It's shocking. It is shocking. For anybody that we're pricing out, we're going to be working all of these options and examples up. And if nothing else, looking for where is the best of the best. These other FHA examples in here that dropped in for the lesser score at 640 to 659 with that small half a point pricing adjustment was 5 1/8. And the 620 with only 3.5% down payment was only 5.5. I didn't price out the 95% financing with 620. We could look at it just very quickly. This is going to take 2 seconds. 95% financing, conventional, 620 is 2.25% pricing adjustment here, which means conventional is going to be up at about 6.5. 6.5 in rate for a 620, 5% down. 5.5 in rate for FHA with 3.5% down, same 620. You can only you can have FHA. VA only allows for 1 VA loan at a time. Very few exceptions for having 2 at one time. If you're being relocated through the and you're active military, they'll allow you a second VA eligibility. There's some exceptions. FHA is all about 1 FHA loan at a time. Exception is if you co-sign for someone and you are a non-occupant co-borrower on another one, you can have 1 as an owner occupant. But if you co-sign for someone else, if a parent co-signed for their kid to help them get in, they're not living in the property, non-occupant, and co-signed as a co-borrower, then FHA allows you to have more than 1. So if I go all the way down here, we're going to look at just a VA option here. We're in the home stretch. VA was the top bucket up here. 5.125% in here. There was no 0.00. 5% was at a slight cost. 5 1/8 was a little bit of rebate. Okay. So if you went in here, once again, for the same government pricing adjustments they have, these are all the same. The 0.5% adjustment is 640 to 659. Means that this goes to a slight cost. It's going to be 0.085% cost, $85 for every 100,000 in loan amount at 5 1/8 for VA. So if you look all the way up to the top sheet, the VA pricing that's in here, 5 1/8 at the 660 plus credit score, there was a little bit of rebate. At the 640 to 659, you lost a half. It was at a very slight cost, same 5 1/8. But from the standpoint, VA has no monthly mortgage insurance. FHA does have monthly MI, but the mortgage insurance factor, HUD just reduced it. So it came down quite a bit. It was 0.85% of the loan amount. It's now only 0.55% of the loan amount. So the FHA monthly MI is really kind of coming more in line with the conventional MI, maybe even cheaper for some loan to values, because FHA doesn't punish for lower credit scores. Conventional and even conventional mortgage insurance premiums punishes people for lower credit scores. So from the standpoint, I always put my contact information on here if any questions arise. Absolutely will. Let me write your email down here before I forget. Write the email, Marjan. All right. So I know that a lot of information. I'm not going to discount that. Marjan, I'll definitely send that to you. Um,
Thank
but
you.
if nothing else, it just kind of, it keeps you, somewhat aware or in the loop. I hear from so many agents that clients are online and they look in lenders' websites and they have everybody's got a mortgage calculator. Oh, I calculated the payment. I know exactly what it is. But see, nobody on those lender websites, when they give you the mortgage calculator, puts in what the what's your credit score, what's this, what's the occupancy, what's the property type. They're not putting all that information in there. So it's kind of like that old adage, like shit in, shit out. I hate to say it, but it is what it is. So you're getting really bad info. So from the standpoint of really like, putting all your faith into, well, the web, there are some people in this world that I've spoken to that was on the internet, so it must be true. I'm like, what are you talking about? I'm not saying that there are bold-faced lies, but in another respect, I just don't think it's really pinpointed to the extent that you and your client would like. To the extent where it's razor sharp, it's exactly for them. And if it turns out that they're like on that non-owner occupied, with 20% down, they're going to get a higher rate. Congratulations. I mean, it is what it is. If you can afford the 25% down, you're going to get a little lower rate. And once again, is what it is. When rates come down, and they're going to come down, then drop down and do a refinance and save money. Drop down to a lower rate, get a lower payment, make more money on your rental. So as it stands right now, I mean, we're kind of like in a temporary, spot in time with regards to where rates are, but they're not going to be here forever. So as rates come down, they're going to be able to drop down, get a better rate, lower their payment. Obviously, it needs to be affordable now. I'm not suggesting, just treat people like, bully them into, well, just take that. No, of course not. So if they're not comfortable with it, I'm not comfortable with it. Or they're the ones signing and making the payment. But at least you have an idea as to where the spread and where interest rates are, where things pencil in, and just how important that prospective buyers, because we spend a lot of time. I've said this hundreds of times. You spend a lot of time and effort getting somebody under contract. And then all of a sudden, once they get the truth be told to them, it is very unsettling. And there are transactions that unravel very quickly as soon as the lender gets involved. Like, oh, I had no idea. We were looking at this rental. I saw online we could get an interest rate of 5.5. You're telling me the rate's 7.5. Well, I thought the payment would be here. Now the payment's up here. Now the rent is not even affordable for me. So this is just a waste of time, and you're not going to get that time back for all the properties you showed and all the offers you presented and all the calls. And, it is agonizing. And I know that there's a lot, for the average person that's out there has no idea how much time, effort goes into what we do as real estate professionals. No idea. Unless you're in this industry, it's a shame that people aren't a little bit more, aware. I think the general public would probably have more respect for our time as well, and more loyalty, quite frankly, if they knew everything that we went into it. People that are good agents and loan officers in our industry that take their job very seriously and are professional. It should be held maybe in a little bit higher regard, I think, than the general public. But like I say, I think some folks out there just, it's the not knowing. It's just their own, kind of maybe naivete or ignorance in not knowing what goes into it all. But it is 1:00, boy. I'm telling you, I stuck the landing for a 10.0 UCLA gymnast, Division I. So yeah, long and short is, you guys can call me anytime. A lot of folks do. I enjoy speaking to you, love putting deals together, and making and breaking transactions. Not everybody's going to go, but there are some people I talk to, I'd be the first one to say, hey, this is what they need to do to get to where they want to go. They're not ready to go right now. You're investing all this time and effort into somebody. Just take it, to the bank, that there are certain things that they need to accomplish in order to get there. I talked to a buyer last night that makes $19.50 an hour, full-time job, pharmacy tech, and wants to buy a place. I asked him how much he would like to keep your payment to. He said about $2,500 to $3,000. lives with family right now, never lived outside of the house. I'm doing simple math. I mean, $20 an hour at 40 hours a week is 800 a week. 52 weeks a year is about 40 grand. It's maybe 34, 3,500, something like that a month. And I asked him, like, what am I missing? How can you afford that payment? And he's, well, I just, and yeah, because what about utilities? What about gasoline? What about insurance? Everything that goes there. Not, well, you need a cosigner if you want to get in, or you need to come down into a price range that's right now he lives in Arcadia. And it came through an agent actually out of our Temecula office of all places. But long and short of that is, we need either a co-borrower or you need to look into a property that's very far from where you live now, because it's just, your neck of the woods is not quote unquote affordable housing per se, especially for somebody that's making $19.50 an hour. But anyway, that's all I got. And I will make sure that email goes out to you, sir. And if you guys have any questions, give me a call. Appreciate your time.
Thanks, Greg.
You bet.
Thank you, Greg.
Thank you,
Thank you,
Greg.
Greg. Absolutely.